This is Capital Ideas TV. Coming up, the founder of Organic Garage, why Whole Foods pricing is smoke and mirrors, Augusta Industries CEO, unlocking value, contributor Fabrice Taylor, how to make money on his 52-week high strategy, and the CFO of Mogo Finance. Organic Garage has been selling organic food at value prices for more than a decade. So what Amazon says it's doing with Whole Foods pricing is nothing new. We talked to the founder and CEO of Organic Garage, Matt Lurie, at the company's new store in the Junction in Toronto. He says Whole Foods pricing is just smoke and mirrors. We talked about that and the company's expansion plan. Here's our chat with Matt Lurie. Matt, Organic Garage is rolling out stores at a steady pace. Give us an update on the expansion.
So we've been busy since opening our third store here in the Junction on July 5th. We're going to start construction on our Liberty Village store towards the latter part of this year. Should be opening probably third quarter of next year. And then we're going to start on our Leaside location during the first quarter of next year. It should be open late third, early fourth quarter of next year. So next year is on track to be a very busy year with 2 stores coming online. So it should be very exciting.
You're very specific when you target areas. So why Liberty Village, why Leaside?
Liberty's a good demographic for us. It's very densely populated. It has a great average household income, higher than normal. The age demographic and population in the area fits our profile. Same thing with the Leaside area. It's a higher average household income, high population density. So yeah, I mean, it fits where we want it to be. Yeah.
Now we're in the Junction store. You have a very unique design to this store, and this is going to be the template going forward. What is unique about this store and the experience for customers that you want to carry forward to the new stores?
We spent a lot of time understanding how we want to convey our brand to customers. I think based off the feedback we've gotten, we've been able to hit that, out of the park. It's a market style atmosphere. It's very intimate. It's a great customer shop. I think it creates the template now going forward for how we want to design future stores. So anybody who wants to see kind of the growth of the brand for the future can come to our Junction store and see kind of where we're going to be in the next 3 to 5 years with all the other stores that are coming online.
And this store has attracted a lot of attention, trade magazines and elsewhere. Tell us about the type of traction and attention that Organic Garage has been gaining, in part because of the way this store looks.
Yeah, so from an industry perspective, Grocery Business Magazine, Canadian Grocer, we were on the cover of both those trade magazines. So from an industry, there was a lot of buzz about what we were up to, how this store differs from all the other stores that are kind of out there. And then from even design magazines, from the way the store is fixtured, the finishing and things that we did, got a lot of traction. Merchandising magazines picked up on it. So it's created a lot of buzz, and that's exactly what we thought would happen, but I think it even exceeded our expectations in resetting the benchmark for what a grocery store can be.
In terms of financials, Matt, you said that you'd like to have at least 20 Organic Garage stores eventually, if not more. So give us a sense of what the revenue trajectory looks like as you open up stores.
Yeah, so I mean, the goal is to open 2 to 3 stores a year over the next 3 to 5 years. We think Ontario can support 20 to 25 stores. And in terms of revenue jumps, just with this Junction store alone, booking 6 months worth of revenue, when it comes to year-end numbers, you're going to see a jump of, 20 to 25% potentially. And then with 2 more stores coming on next year and 2 to 3 stores every year after that, you get to see kind of those large jumps that the market likes to see in terms of year-end revenues.
Lastly, let's talk about Amazon and Whole Foods. We've discussed this before. We know a little bit more now. There are some studies that say Amazon with lower prices is hurting organic food stores in the United States. Then you see studies that say that's not the case and prices have barely budged. So what are you hearing?
Yeah, so it's what I originally thought it was a marketing ploy. It was to drive some traffic into the stores. But what we saw post, these price drops is a lot of trade magazines have come out doing their price checks and have shown that really it was a lot of smoke and mirrors. We sent in our own people the day after they announced their price drops to do some price comparisons. And I know specifically in produce, we price checked 25 commodities, and on average we were 20 to 25% cheaper. So even with those price drops, they're still overpriced, and it doesn't deviate from our direction and our model going forward. So for us, it's what I thought. It was a a lot of marketing, a lot of smoke and mirrors, and I think people are starting to see that now, and that kind of aura of those price drops is wearing off very fast.
And do you think this whole idea that Whole Foods was going to hit the Canadian grocery sector was overblown?
Yeah, I mean, their penetration here in Canada is relatively low. I think they have 10 to 12 stores across Canada, so I don't think you know, they can affect stores the way they might potentially in the US, but still, their model inherently leads to a higher price on shelf, and our goal is to continue to lower pricing and widen that gap. And like I said, even with those price drops, 20 to 25% cheaper in produce alone, we're not seeing any effects whatsoever.
When Capital Ideas TV contributor Fabrice Taylor was taking his CFA several years ago, in one of the textbooks he discovered a trading strategy that he uses to this day, and that is buying stocks at 52-week highs. Fabrice has refined his strategy over the years, and right now he's going to show you how to make money from it. Here's our chat with Fabrice Taylor. Fabrice, we've talked about your theory having to do with 52-week highs and 39-week highs in the Capital Ideas Digest. We often post and do stories about the high list, and you've talked as well about how you discovered this, taking your CFA years ago and going through these monstrous textbooks and not really caring for the process, but finding this nugget one day.
It's true. You know, when I took the CFA, it's a tough course, 3 years and lots of books. The stack of them was taller than me. And yet, the most valuable thing I discovered was in one little chapter, one little paragraph, in fact, in one of the books that said that there were statistically only two ways to beat the market. You could be a Warren Buffett-like value investor, which in fact you can't be because there's only one, and it's very difficult to do that. And the other was to buy the high list and short the low list. Let's just talk about buying the high list, because most people don't short, let's be honest about it. The theory behind it is that the market is the best investor, right? It's smarter than you are on average, than I am. And so it's making choices, and not the whole market, it's not that the whole market agrees, but like the preponderance of it, the smart money is in there early, and it's deciding something's going to happen here. There are good things happening here, and it will generally drive the price of a stock higher despite the resistance. And that's when stocks start hitting highs. And what you want to do is buy stocks that are starting to hit 52-week highs, because here's what they all tend to do. They tend to do it over and over and over and over again for several years, especially if you get in there early. Now, it doesn't work for everything. Obviously, very volatile companies or illiquid ones or small ones doesn't work as well, right? Because, I mean, if you take a microcap that's not very liquid, it could literally hit a high and a low in 1 month. But for bigger names that are more liquid, that are better known, where the information is generally well established, you can do very well. And that's a very good way of investing if you want to be a do-it-yourselfer and have a chance at beating the market.
And then Fabrice, you refined this theory over time. Tell us about that.
So it's not just blindly buying the list. As I said earlier, volatile stocks, they don't work as well. Illiquid stocks, smaller names, doesn't work as well. And you also have to do a little bit of work. Like when you see a stock appear on that list, you should take a few minutes to just understand what they do and why are they hitting a high. Is there a good reason for it? Is it a reason that you think will carry over for several quarters or years? Or is it speculation that they might get taken over? You really have to do a little bit of work, but I'd say 80% of the work is done for you once you narrow that list down.
And we're looking at some great examples here. We're seeing a LINAMAR, for example, and we're going to roll through a bunch of them, hitting a first 52-week high and then doing exactly what you say, going on to hit higher highs after higher highs over several months.
Yeah, you can see from this chart how smart the market is, because earlier this year it looked like auto sales were rolling over. It is cyclical, obviously. There's only so many cars that are going to be bought. There's only so many people who buy cars. And you can see there was weakness in LINAMAR and others. Just this week we had auto sales sharply higher, but look how smart the market is. It anticipates it by a couple of months. It sees it coming. And that's what I mean by the intelligence of Mr. Market. Sometimes we make fun of it. Warren Buffett makes fun of him sometimes, but generally he's pretty smart, and you can see it in this chart. And if you took the cues from the market and you bought it back then, you'd be doing very well. And you can see here Pollard Banknote. It's a little company based in Winnipeg. They actually make those lotto tickets that you buy and you like bingo or whatever. And they made an acquisition in the video game, the digital space, And what this chart tells you, you can see the stock sort of stuck there. It's a no-growth business, pays a little dividend. They make an acquisition, stock starts to move, and this is the market affirming to you that this is actually a good deal. And if you've taken your cues here again, you're almost doubling your money.
The airlines, such as the Air Canadas of the world, have had a good run, lots of 52-week highs there. You want to make a comment about them?
Well, Air Canada is the leader in that space. It's outperformed WestJet, and that's because the entire economics for the airline industry are improving, but Air Canada has more debt. And so when things are going your way and you're more indebted, you get more leverage. So that's why it's doing better. And again, add a little bit more research to what you're doing, not just look at the list, and you can refine it and say, you know what, I feel good about the airline industry. All these airline stocks are hitting a high. I'm going to go with Air Canada because it has more debt and more leverage and therefore more of a return.
So Fabrice, in the last month, we've seen this theory play itself out once again. We have an example here with Magna.
Yeah, so Magna may be playing catch up with LINAMAR here. I'm not exactly sure, but certainly one to look at. It's breaking out. It's hitting new 52-week highs. The odds are that it'll continue to do that. So it's worth digging into it and finding out why exactly is this stock moving and is it worth buying.
And the next one up here is Logistec.
This is a smaller name. I did take a quick look at it. I think it's interesting. They put out some guidance and they are very bullish on their future. So I'm thinking, although it's a volatile stock, it may be worth looking at because it sounds like their tone has changed and that things are picking up in their industry.
And lastly, I get the sense that you run screens pretty well every week on these high lists and you try to identify why they're moving.
Absolutely. That's where I get a lot of my ideas. I look at the screening, I look at the high list, I look at the 39-week high sometimes if I get a little more aggressive because it's a little less sure at the 39-week level, but nonetheless it can work, and then you're in there a little bit earlier. I also look at the short list, and you never ever want to buy a stock as a retail investor that's hitting 52-week lows because you will lose money, period. There's no way around it.
So don't bottom fish.
Never. That's for institutions. That's for guys who have to buy millions of shares, and there aren't millions of shares available when the thing turns around. Then it's too illiquid. So they're out there buying when everyone's selling, but they're more patient. They have to be either bigger. As a retail guy, don't even try it.
The technology of Augusta Industries is used in many different sectors, in part to detect and prevent leaks and corrosion in pipelines, for example. The company has a lot of big-name customers such as Enbridge, Chevron, and NASA. And Augusta Industries is spinning out one of its subsidiaries to unlock value. To talk about all of that, here's the CEO, Alan Lone. Alan, Augusta Industries is spinning out its Fox Tech subsidiary. Why are you doing that now? And explain the structure of the deal.
We RTO'd Foxtech in the past and had cleaned up the balance sheet, reorganized the company, focused on data analysis and services, engineering services. But frankly, the company's gone a long way into that path, but it hasn't really shined on its own. It's sort of smothered by being in existence in a holding company, Augusta, and with a sister company, Mark International, having sales on the other end in a parallel track, really not having too much synergy in between them. We've got a few add-ons that we have brought on leak detection, temperature and pressure sensing, and a portable electric field mapping dealing with corrosion that could be used as a tool rather than a continuous monitoring solution. And we thought the best path to do that is to have it as a standalone company and basically shine on its own. It's time to do that. We've got a lot of clean tech opportunities coming up on the leak detection with some of our major clients. And the structure will be based on a $25 million that will go back to shareholders. We are going to distribute the majority of that, just consulting right now based on tax practices what is best done to for the shareholders. And on the other hand, we're putting a $3.5 million offering on a table at 50 cents.
Now, you mentioned clients. You do have some big names, including Enbridge, and they have an article on their website, which I was looking at today, that talks about your technology. What's the impact and importance of that, do you think?
Well, Enbridge really sits sort of on the top of the hill. They've really championed our technology. They've acquired a number of systems. We currently have 2 long-term contracts, Enbridge US and Enbridge Canada. We are also crossing from corrosion monitoring alone with 18 systems right now on pipelines live and active 24/7 with our non-intrusion technology when it comes to the corrosion side. But we've leaped to marrying that with leak detection. There are a few opportunities coming up, and at this point we can't really talk about details until we go through the process and talk some more. But that's sort of the clean tech, along with corrosion monitoring, being proactive when it comes to any accidents in the future or any breach in corrosion or otherwise. Our leak detection is based on volatile organic compounds, sniffing, basically being proactive, sniffing pipeline lanes for gases, CO2, liquid, and so on.
Now, you touched on Marcon, another one of your subsidiaries, and you've been signing some contracts. Can you give us some insight on that?
Yeah, Marcon is a contracting company, mostly dealing 85% of our business is in the U.S. with the U.S. government, a number of the agencies, and we basically have signed contracts for approximately $2 million so far since early August, but we've signed an additional probably $1 million or so earlier in the year, and we basically focus on supply and services. We'd like to expand that a little more, and we have ideas towards adding sort of an engineering division to Marcon, where we were able to bid on contracts that have some engineering. A lot of the engineering work has better margins than just supply and services, and that's our focus, to grow the business and try to add more sales.
Now, Alan, you say that your company is on the verge of and the cusp of explosive growth. So make the investment case for people who may be skeptical or don't know the company that you're going to get there, and how do you get there?
I think the key tranche there when it comes to clean tech is sort of the buzzword. Marrying that with our DMAT, which is our data management analysis. It's all artificial intelligence that are based on modules and formulas that scientists have come up with that work for us in our engineering team. I think there's a great need for leak detection monitoring. Major companies, without naming any names, have all been in this maze trying to find the best opportunity, and right now we think we do provide the best. We are going through some testing right now to get third-party recognition that this is the best, and there'll be lots of eyeballs on that. You know, if we anticipate that we'll be doing 4 or 5 times more in leak detection than we ever will in corrosion monitoring.
Mogo Finance Technology calls itself a digital finance company. It offers loans, mortgages, free credit scores, and credit cards, and it plans to branch into other products. The company's growth trajectory is solid, and many analysts believe the stock should be trading at a much higher level. Mogo is run by identical twin brothers. We caught up to the president and CFO, Greg Feller. So Greg, Mogo Finance Technology does exactly what it says it does. It's in finance technology. It's a fintech. But how are you different? How do you stand out from the crowd?
So at Mogo, we're really building a next-generation digital financial experience for really the next generation of consumers. So think of us as a next-generation version of an ING Direct. ING Direct was really the first online bank in Canada. They started with an online savings account, grew their member base, and then expanded into other products. At Mogo, we started with an online loan, and now we've launched our Mogo digital account. It takes you 3 minutes to open up the account, and you get access to Canada's first free credit score monitoring. You get access to our new digital spending account, which really enables consumers to control their spending, our digital mortgage experience, and the consumer loan. So you're getting the convenience of 4 digitally led consumer products in one. Nobody else has that in Canada. The account links directly to your bank account, so we really work seamlessly with the consumer's current banking relationship. And then it's supported by a very strong team. We have over 100 people in our technology team, really sort of building what we believe is Canada's leading digital experience.
Now, broadly speaking, would you say that Canada has been slow to adopt financial technology, and is that a problem that you want to solve, or does that mean you have that much more runway to grow?
Well, I would say both, yeah. I mean, Canada is behind. US is behind Europe, but Canada is behind the US. Canada's actually grown a fair amount, but we've got, Canada would need to close to double to basically get to where the US is today. So there's still a lot of growth. Bottom line is, it is very early days. We believe we are, one of the pioneers, not just in Canada, but in North America. We started the company 15 years ago, but these trends, they then start to take on momentum, they start to accelerate, and we think we're very well positioned to benefit from that.
Now, in your last quarter, you said you had roughly 440,000 users. That was nearly double from last year. You want to get to 1 million in about 3 years' time. So how do you get there?
Well, we actually struck a very innovative marketing partnership with the Postmedia Group here in Canada, which basically now gives us millions of dollars of marketing spend at a level that a company our size could not afford without this deal. In return, they're getting a revenue share and they have warrants in our company. But effectively now, that has allowed us, along with our new digital account that's very easy for somebody to open, to really drive down our customer acquisition costs. It's now below $20, and we're signing up 16,000 members a month. So really at our current run rate and with our current base of members, if that continues on, we will hit that 1 million member number over the next 3 years.
In your last quarter, you had record gross margins. You're profitable on an EBITDA basis, but not on a net basis. So give us a sense of the financial projections going out a year or two. What does profit look like? What does revenue look like in margins?
So what we've guided the market towards is accelerating revenue growth in the second half of this year. Q2 was the first sequential revenue growth we've had in a few quarters, as we've been focused previously on building out the platform. Now that we've launched that platform, we have these new products growing. We also just recently completed a convertible financing, which now gives us a bunch of capital to start growing our loan book again alongside of these products. So analysts have growth accelerating really for us in the second half of the year and definitely in 2018. If you look in the long run, our goal is to be at 1 million members in 3 years. Our average revenue per member today is just over $100 per year. The average revenue per member of the top 10 credit unions in Canada is $1,300 per member. In 3 years, we would like to be somewhere between that $100 that we're at today and that $1,300 that a credit union's at, and hopefully be at that 1 million member mark. And that will really be about continuing to increase penetration of our existing products and roll out new products to our members.
And lastly, Greg, I have to ask you about your journey as a public company. You go public in 2015 at $10 a share. It's a long ride down to about $1.10 for a variety of reasons. Now you've quadrupled from there. And there are analysts who say you're trading against your peers at an undervalued level and you should be worth a lot more. So just tell us about the journey and where you think you should be trading.
Sure. So look, we went public 2 years ago, really at the end of the IPO window. We came out right below the initial expected offering price for some actually reasons that brought in some really good investors, but to the public market that was viewed negatively. We kind of caught on a downward trend out of the gates. The US players were also down at the time, and we just kind of got sucked up into that, even though we grew our revenue 86%. We effectively regrouped at the end of 2015 and decided to focus 2016 on building out this platform. We weren't focused on revenue growth, which meant it was kind of a bit of a slow year from the equity side. But now that we're in 2017, we've launched the new account, we've launched the new products, and we've returned to sequential revenue growth in the last quarter. We believe that we're now really back with all sort of engines firing, and we think that that big discount that you referred to the peers will continue to go down as investors start understanding the platform we've built and the growth that we see going forward.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Be sure to subscribe to our YouTube channel so you don't miss an episode. And for more great investment ideas through our weekly digest and morning note, subscribe to capitalideasresearch.com. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.